G'day, I'm Jonathan Bayes, and these are our thoughts on investment markets for the month of April. And this month we're pleased to have Andrew Lockhart, the CEO and one of the founders of Metrics Credit Partners, giving his views on the Australian corporate loan market. For many of you, you might already be very familiar with Metrics. It's one of the key funds within our defensive asset allocations. Provides great unfranked dividend income to investors. Currently yielding actually over 6%, well in advance of the 4 3/4 that the guys had been targeting at the point of IPO about 18 months or so ago. We thought, given that we're now into April, this month would be a good opportunity for us to take stock on the performance of major equity markets and more broadly asset classes year to date. And as you would well be aware, the start to 2019 has been fantastic, and we've recouped virtually all of the losses that we saw in that horrible quarter to the end of December last year. Markets across the board up about 10 to 15%. Leading the pack has been China, which is up well over 30%. Australia's up about 11, just under 12% year to date as well, and defying the slowing local economy. With the strong performance of share markets around the world year to date, you would think that the global economy is perhaps doing better than it is. And in Australia, as we've mentioned for several months now, the local economy continues to be weakening. The service sector is at a 5 or 6 year low. Employment trends are now starting to suggest that maybe we've seen the peak in the unemployment rate here in Australia, just under 5%. Yesterday we had ANZ job advertisement figures down 6% year on year, which is about a 6 or 7 year low, and certainly pointing towards the unemployment rate creeping up towards 6%. Globally, we've seen, I guess, a stabilisation in manufacturing data, particularly in the US and in China, but we haven't seen a rebound just yet. And so I would say that with share markets within 2 to 3% of their highs, there is quite a degree of optimism now being priced into equity markets. And again, as a result, we continue to maintain the caution that we felt for several months. In the United States, interestingly, the New York Federal Reserve have got an indicator on predicting the potential chance for a recession within the next 12 months in the United States. That number has been creeping up despite the fact that equity markets are feeling more optimistic. It's now at 27%, which is the highest figure we've seen since the GFC. So there are warning signs out there, but at the moment equity investors are choosing to ignore them and to take a positive view that perhaps the economy will bottom out and that we will get a likely resolution to the ongoing talks between the United States and China.
Hi, I'm Andrew Lockhart from Metrics Credit Partners. We tend to see a range of activities from our corporate clients across a number of industries, and those clients are active in all aspects of the economy. And so that gives us a unique perspective in terms of what's going on in the economy and how our various borrowers and corporate clients are performing. Generally, we've seen pleasingly, we've seen good solid performance from most of our corporate borrowers. We're pleased with the performance of their businesses. However, we do see areas of the economy where we're seeing difficulties, and most notably we've seen a decline in sectors that are exposed to the consumer. So areas such as restaurants, bars, hotels and the like, where consumers have reduced spending activity. The financial performance of some of those companies that we lend to in that sector have seen a slowdown or a slight deterioration in terms of financial performance. Equally, we also see in the property market, as the banks have withdrawn capital, difficulties posed in that part of the market. Looking out over the course of the next 12 months, I guess the immediate short-term concern is the risks posed by a potential change to the Commonwealth Government and potential changes in policies that may result and how that may impact investment markets. Obviously, as a lender, we're acutely aware of potential risks associated with policy changes or missteps and how that may flow through to the broader economy.
Recapping for you too, we've just had the federal budget. Last week it was a good one. Small to medium-sized businesses are definitely benefiting, and so too are low to middle income earners. On both sides of politics, there'll be beneficiaries. Whether the budget is good enough to get the current government over the line in mid-May, we'll wait and see, but the odds are certainly stacked against them. Our portfolio remains defensively positioned, particularly here in Australia, on account of the declining economy anyway. We do think the Reserve Bank will be pushing through rate cuts perhaps as early as June and July. That should put some pressure on the Australian dollar and see that back into the mid-60s. And again, we feel like some of our key positions should benefit. So Downer does well on the back of the infrastructure spending. Telstra should do well, as both sides of politics are very likely to write down the value of the NBN, and that will be a good thing for reseller margins. In the case of Telstra, Amcor, another major holding of ours, should do quite well with a weaker Australian dollar, and so too should Nufarm. So again, we feel like we're positioned for it. We're waiting for the decline in the economy to continue, and in the meantime, hope you have a great month.